Good afternoon, everyone. Welcome to our webinar today, the Modernization of Payment Systems. Thank you for joining us. And the Caribbean Confederation of Credit Unions has partnered with Digital Financial, a boutique consultancy of experts headquartered in Toronto, Canada, who have deep experience in all areas of financial services. Mainly focus on addressing regulatory, management, business, and technical needs at every stage of digital transformation. I would like to thank Lisa, Peter, and the panelists for putting this webinar together and express special thanks to our main presenter, Brad, who is presenting from a 14-hour time zone difference today. Without further ado, let me invite Lisa Skinner, Managing Partner, to moderate the session.
Thank you very much, Denise, and thank you to the Confederation. I would like to welcome our attendees who come from central banks, development institutions, and most importantly, from credit unions. Today's webinar is not a technical discussion, as some of the issues of technology, security, and identity will differ depending on the path to digitalization which each of you choose to follow. The goal of the webinar, instead, is to provide an overview of the strategic considerations which surround participating in modern payment systems. I would just like to run over how today's event is structured. Brad Pragnell will present an overview which will take about 30 minutes. This will leave us about 25 minutes for questions to the panel. Please submit your questions via the Q&A function, and you can vote up any questions which you deem important. We won't be answering them in the chat function. Instead, our moderator will submit them to the panel after Brad's presentation. And I'm sure there's likely to be some questions that we don't get to that are very important. And for these, we will post answers on our website and also circulate them through Denise. One quick mea culpa, due to COVID, Brad, as already mentioned, is in Australia. One of our panelists is in Scotland, and the other panelist is in St. Lucia. So if we have some conductivity issues or suddenly someone has to turn off their video, please forgive us. And now I'd really like to introduce Dr. Brad Pragnell, who has led payments modernizations in Canada, Pakistan, and Australia. Brad has a deep history in setting up and working with member associations, and he has a passion for collaborative models in financial services. Okay, take it away, Brad.
Thank you very much, Lisa. Good afternoon, everyone. As Denise and Lisa mentioned, I am zooming in from Sydney, Australia, so 14-hour time zone. So again, please forgive me in terms of any slowness or connectivity issues, but hopefully technology will be on our side today, and we will be able to get through the presentation and then into the panel. I'm about to screen share my presentation. And presentation mode there. And first of all, I'd like to say thank you very much to Denise for organizing this and for Lisa for introducing me, and I look forward to the discussions with the panel. So today's presentation is really looking at payment systems and payments in the modern era, and really looking at how it impacts credit unions, particularly given the challenges that you're facing in the current digital economy. So here's a bit of a presentation agenda. As we've mentioned, we have going to be going through some definitions, a bit of the key processes, discussing some of the systems that you currently would participate in or are thinking about participating in. We're then going to get to brass tacks and talk a bit about the payments revolution, and then really focus on the call to action. What can you do? So really, what are the issues that you need to consider and think about as you're preparing going forward, thinking about payments and how payments and payment system participation fits into your future agenda. Really, in terms of the discussion today, what sits at the center of any of your consideration are your members. Credit unions exist for their members, and really about delivering the financial services that they need to be able to flourish. So again, as the world is changing because of the digital economy, because of the impact of the internet and mobile phones, it really is incumbent upon credit unions to work through and think about these issues going forward. Excuse me. So we'll start off, as any good discussion on payments is about, is to really think about the role of money. So this is a bit of first year economics, but again, I always think it's good to start at first principles. So money has a number of roles. One is as a store of value in terms of actually saying what has value. It's unit of measurement. It allows you to compare two things. Something is worth $20 and that something else is worth $30. And then thirdly is a medium of exchange. So it allows economic actors to be able to transact with each other to exchange value to acquire products and services. So that's really what we're going to be talking about. And when you're thinking about payments, it's more than just a merchant payment. It's more than me just walking into a shoe store and buying a pair of shoes. That's an important type of a payment transaction, but it's not the only one. It could be employee payments, it could be government payments, it could be business payments. So when you're thinking about payments, it could be cross-border remittances. So when you're thinking about payments, we really want you to think broadly about the topic. So let's start with a few definitions. The Bank for International Settlements is effectively the organization that coordinates the activities of the world's central banks. And they define a payment, which they also call funds transfer, as the payer's transfer of a monetary claim on a party acceptable to the payee. Typically, claims take the form of cash or deposit balances held at a financial institution or at a central bank. So that is a payment. Payment system, just trying to move my little thing here, is a set of instruments, procedures, and or rules for the transfer of funds between or among participants. The system includes the participants and the entity operating the arrangement. The entity operating the arrangement might be known as a clearinghouse, payment system, or system operator. So we'll be using some of those terms to describe the entity that sits in the middle that ends up processing the transactions between the parties. So payment systems have been important since the beginning of money-based trade. So as I mentioned, they connect economic actors so they can pay and be paid. Creates efficiencies and network effects. So that's a really important thing to realize about payments. They are networks. They connect economic parties. And that's really a lot of their value. It allows me to go into the shoe store and buy a pair of shoes. It also allows me to send Lisa $20 so we can split the bill because we've just had lunch out. This would be kind of more in a pre-COVID world. So it allows these kinds of activities to happen. Importantly, the payment systems themselves remove friction and they manage risk. So risk is a really important thing to think about when you're thinking about how payment systems are constructed and how they operate. Because we are dealing with money. We're not just dealing with the transaction of any old data. We're dealing with monetary claims. We're dealing with value that can be used for a lot of different purposes. A little bit about the history of payment systems here. So we've had payment items such as bills of exchange used in the Renaissance for hundreds of years. And these payment systems enable value to be exchanged between accounts at different banks, companies, guilds, and unions. So modern payment systems really go back to the 1770s in Great Britain, where you would have had the bank clerks who would have met in a London tavern to exchange checks. So that created some of the efficiencies that we see in terms of what we talk about when we talk about netting in payment systems. So modern payment systems do find their origin in checks. The first permanent committee to regulate clearing was established in London in the 1820s. And since then, banks and other financial institutions and central banks have put a lot of energy and effort in terms of managing these systems. The role of central banks. So central banks play a very, very important role in payment systems. They focus on financial stability and systemic risk, and often they provide high value payment systems, but generally they don't provide retail payment systems, although they may support these systems. Central banks support payment systems by issuing currency, operating the payment system infrastructure, providing banking services to government, and oversight and regulation of payment systems. So central banks do play a very important role in terms of supporting the payment system, primarily in terms of those supporting infrastructures. Other public regulators may license payment systems, and they may focus on things like protecting consumers, privacy legislation, anti-money laundering legislation, and so forth. So all of these things will impact on payment systems and on payment system participants. So why are payment systems and payments so important now? So I've already talked about sort of the three things that they do historically, but what are they doing now? So importantly for central banks, payment systems, and as they modernize, do things like to support monetary policy, so that central banks can use payment systems, the management of the settlement accounts that they may hold, to support monetary policy in terms of the interest that they pay on those settlement accounts, really managing a lot of the economic impacts. Increasingly, regulators and central banks and governments are looking at how they can foster innovation and promote financial inclusion. And financial inclusion is obviously very important in developing markets, particularly in a number of Caribbean nations, in terms of how do we get people to participate in the formal financial system. For credit unions and other financial institutions, really what it's about is about addressing swiftly evolving member needs. So the members are changing and evolving, obviously. They may have access to phones, they may have access to internet, they may have much more different needs than they would have had, say, even 5-10 years ago. And I think that's a lot about what we're going to be talking about going forward in this presentation. So a little bit about the payment system actors and how they all fit together. So here's a very basic payment system. It's highly simplified. So don't use this as a technical drawing or as a payment flow. It's more to just describe the main actors. So on one end, you'd have the payor, who would be an end user. Say, for instance, that could be a customer, that could be me wanting to go buy a pair of shoes, as I've already mentioned. It could be me wanting to remit the $20 to Lisa. I would have a financial institution where I would have an account at, and then I would initiate somehow that payment to be made. It might be by drawing an instrument such as a check. It could be making a credit transfer. It could be a card payment. That payment instruction would usually be processed by some kind of clearinghouse, by payment system operator, who would then route that transaction to my counterparty's financial institution. So, and then that would be resolved, and then my account would be debited, and the other person's, the payee's account would be credited. Over top of quite often of payment systems, of the clearinghouses that operate them, would be governments, so in terms of the regulation of them, and then importantly, central banks. So central banks, as I mentioned, play a regulatory role, but they also might play other roles and functions as well too, holding settlement accounts and providing certain types of payment infrastructure and support. But the important thing to realize is that these systems only work if the individuals and businesses want to participate. So how do you create trust and how do you create buy-in? So really, when you think about payment systems, they have sort of three electronic payment systems that really have three aspects. They have rules, they have technology, and they have brand. And we'll talk a little bit about each of these. So first of all, about rules. So payment system rules define what participants in those systems, so the financial institutions that I talked about in my diagram, must or can do. It defines, for instance, the governance, who can make decisions and how a decision is made. So access, who can participate, how can financial institutions participate, and on what basis. The exchange of those payment messages between those two parties. How are the messages formatted? How are they submitted? What is the security associated with that? We have the clearing and settlement functions as well too. So clearing really about how are those financial obligations between the two participants determined, and then finally settlement, which is how the financial obligations between the participants are extinguished. So how are they actually resolved? And in the end, that allows that transaction to be completed. So rules create governance, they create functionality, they create security and trust. So they provide all of these important features in terms of supporting a payment system. Payment systems also quite often have technology. And I won't get into too much about multilateral and bilateral, but really they will provide the tools and technology that allow the participants to transact with each other. So there may be a physical network that connects the participants on either end of that system. That could be through the internet, or could be through leased lines, or it could be through some kind of proprietary network. So there might be some kind of physical connectivity there. There could be a message switch, some kind of central hub that routes and directs the messages between the participants. And then lastly, clearing and settlement support. So providing that clearing system, or that clearing house that we had in our diagram, in terms of how clearing and settlement could happen, potentially final settlement happening at the central bank. So the technology creates efficiency, functionality, security, and value. And lastly, brand. So brand is pretty important, and there's a good quote here from Steve Harvey: brand is a constantly evolving entity. So payment systems have quite often developed their own brands. So Visa, MasterCard internationally. In terms of domestic schemes, we have Interac in Canada that operates the ATM switch and the debit card network, and say newer systems, iPago, for instance, the new fast payment systems in Aruba. You know, they all are developing their own brands and their own corporate identity. As part of that whole commercial arrangement, quite often these schemes will also govern price. So they will set fees for their members, but they might also control some of the fees that happen between those participants. So you may have, you know, in credit card schemes, there is the idea of interchange, where the participants, financial institutions on either end of the transaction would actually be paying each other for that transaction, which creates an economic model which is designed to incentivize the participants to participate in that scheme. So branding creates identity and recognition for the users. So from a retail perspective, it allows people to actually look at and understand what they're actually using. So it creates awareness and trust, but it also carries a degree of reputational risk. If you make a mistake, then people might lose trust in your brand and they may not want to use it. If they have good trust in your brand, then they're going to use it. So it can be a little bit of a double-edged sword. I'll briefly go through some of these definitions now. So I won't spend too much time on this, but just to make a little bit of a distinguishment between kind of older style legacy or existing payment systems that might actually be operating out there that some of you may currently be participating in or thinking about participating in, just create a little bit of distinguishment here. One is around automated clearinghouses, and usually automated clearinghouses involve the electronic exchange of messages between participants. So they may handle bulk exchange, they may handle even check payments as well too. And they really are, they're operated by usually commercial bank consortiums, and in some instances by central banks. I think the thing about these ACHs is that they really are the unsung workhorses. So quite often in some jurisdictions, they can handle the vast majority of payments, of electronic payments that are transacted between parties. Some of the challenges around those automated clearinghouses is that quite often they have limited data capability. I worked in Australia for many years, and our bulk electronic clearing system, which was our ACH, the only data you could really provide with the payment was, I believe, an 18-character reference. So that made it very difficult for reconciliation. It made it very difficult to provide data with the payment, which meant that it limited its usability in some instances. You had to attach the remittance information separately. And ACH is quite often clear and settle overnight. So that means that the value at either ends of the transaction might take a day or two. If it's only business days, you might not get your money until Monday. So there's sometimes can be a little bit of a slowness in ACHs. They are changing and reforming, and you're seeing more ACHs that settle on a same-day basis or settle on a multiple same-day basis. But historically, they still operate on a delayed basis. High value systems or real-time gross settlement systems quite often are operated by central banks. They usually allow for high value transactions. They rely on swift technology, real-time clearing and settlement, and usually have liquidity savings mechanisms. The challenge with these systems quite often is that they're too expensive to use for certain types of transactions. If you're being charged, say, Canadian dollars or US dollars, $15, $20 for wire transfer, as they're called, a real-time gross settlement payment, then quite often that doesn't necessarily work for you as someone who's trying to send, say, $100 to a family member. So we're looking at different alternatives to try to address some of those cost issues. So ACHs and high value payment systems usually have rules and technology. They don't necessarily have a brand. They may have a name that is known to their participants, but it's not actually a well-known brand that's used by consumers. So when a consumer is making, say, a real-time gross settlement payment, a wire transfer, or they're doing ACH, they wouldn't necessarily know the system that they're actually using. So what's wrong with what we currently have? So these traditional payment systems have their limitations. They're quite often based on old technology. As I mentioned, there's a slowness in terms of when value is received by the recipient. They may have limited hours, so processing only happens on weekdays or normal banking hours, and there's limited data with the payment. So that's some of the challenges associated with some of those traditional systems. So what does your retail or commercial member want? So we're moving into a new world. They want things to be immediate, 24/7, fast, available all the time, easy to set up, easy to use, safe, and an ability to do it in multiple ways, and ability to access cash. So what people expected, say, even 5-10 years ago, or what members expected, what consumers expected, is changing. They have mobile phones now, they have internet connectivity in some instances, and they're expecting payments to move as quickly as how they can transact on the internet. So we've seen changes happening. We have international card schemes now that are very active. So well-known brands, Visa, MasterCard, American Express, and Union Pay. Generally, these are operated by large for-profit international companies. They have huge global reach, wide range of products, credit cards, debit cards, prepaid cards. They usually operate through financial institutions, but not always. They have deep technological capability, and they also have an attractive economic model for issuers. So as I mentioned, these international card schemes, your Visa and MasterCards of the world, have interchange fees that are paid between the participants, and that can be very attractive if you're issuing their cards. The challenge with that economic model is that it's not always attractive for merchants because of the way in which people are being charged. And I'll talk a little bit about that later. Concurrently, you will also have domestic card schemes, which might also be operating an ATM switch or a debit card switch domestically. This allows for ATMs to be interconnected, or for people at one financial institution who have a debit card to be able to use their debit card at a point of sale machine that might be provided by a different financial institution. So, and where the merchant may bank at a different party. So quite often these operate on a domestic basis. More often than not, they have less functionality than international cards, but usually they're lower priced, which makes them attractive to regulators and merchants concerned about costs. And increasingly domestic schemes, ATM switches, debit card switches, domestic card schemes are offering prepaid and email money transfer options. So they're going beyond their traditional ATM switch or debit card switch to offer new services. And we've got a few examples here: Interac in Canada, Links in Trinidad and Tobago, Jex Multilink in Jamaica. So we've had these systems operating for a number of years. So when you look at these systems, they quite often have the rules technology, but also the brand. So that's a very important thing to think about in terms of thinking about them. So they very much focus on the retail brand, on the experience, and also on the economic model that underpins that. So they have the rules and technology, but they also have that third dimension as well. So why would you consider anything more than cards? I know many of your organizations are involved in cards, and you would think, well, don't cards solve most of my problems? Because again, looking at the things that your customers are looking for. But I think the thing you got to realize is that cards don't do everything. So cards are great, but they don't solve all your problems. So cards were really designed for primarily for point of sale merchant payments. If you're thinking about not only debit cards, but say credit cards or prepaid cards, they really were designed for that. So either for a point of sale merchant payment or for being able to access cash from an ATM. So over the years, they have been adapted for online payments, business payments, and person-to-person payments, but that translation doesn't always work. Cards carry limited data, so the messages between the participants don't necessarily carry rich data that makes them useful for things like business payments. So you have newer payment systems based on the ISO 20022 messaging standard. I won't go into too much detail on that, but it does really allow you to have that data capability. So cards don't necessarily provide that. They have other features. So they have chargebacks in the instances of fraud, and they also have an economic model in terms of charging the merchant that make them attractive to the card holder, but not necessarily as attractive to merchants. So particularly say micro businesses or government who are not really interested in paying for that service. So in 2008, we had the payments revolution, probably 2007, 2008. A couple of really important things happened. In 2007, M-Pesa was launched in Kenya, sort of one of the first well-known mobile money services. 2007, we had the iPhone. And in 2008, we had the launch of the UK faster payment system. So around that time, we really did see this new world emerge. Internet banking, mobile apps, PSPs, the whole fintech revolution probably can be traced back to those events. So how do you navigate this? How do you actually understand what you should and shouldn't be doing in an increasingly complicated world? So we have these new payment system players. I don't want to spend too much time on this slide. It's a little bit text heavy. But again, if you're thinking and trying to categorize these people who are coming at you, really need to think about, well, where do they play in respect to me? Do they provide a front-end service? So potentially a mobile app that sits in front of the services that I provide to my members. Do they provide a back-end service? Do they support me in terms of providing some kind of technology support or hosting some kind of data? Do they operate payments infrastructure? So ACHs and card schemes play these kind of roles, or do they provide some kind of end-to-end solution? So some of the mobile money solutions and some of the PSPs out there might actually offer an end-to-end solution. So it's really incumbent for you to think a bit about, well, where do they fit into where you're playing? So what can credit unions do in the near future? Well, we really think you should think about a few things. First of all is the why. So really our central banks and regulators, as well as individuals and businesses, are looking to transact for many, many reasons. So we're calling the 3 C's. So there's COVID. So people are staying at home more. They might be doing more electronic type payments, remote payments. They might not be using cash as much. Cost, quite often electronic payments and digital payments are cheaper, and convenience, they can be easier to use. So then if you really think about the why, really about how do you deliver value to your members. So the what, so what is your business vision? What are your strategic objectives? Do you need a full suite of payments options, or maybe just a few? And lastly, thinking about the how, really the key considerations being around responsibility, control, and scale. So I've got a few quotes here. I won't necessarily go through them, but I think central banks are really operating to try to create some of these opportunities. They're thinking about financial inclusion. They're thinking about digital payments and digitizing the system, moving away from cash and checks where possible, and also about opening up participation, making it easier for smaller and newer participants to be able to participate in some of these payment systems. So there's some great quotes here, and I think really this is some of the change that we're seeing. So again, when you think about the why, what do your members want? And we've got all the members here that we've sort of seen in various diagrams so far. Again, you could be servicing just a very narrow sort of occupational group. You could be supporting a wide community, but you really do need to think about what kind of payment options do they need. So we've got a bit of a cricket pitch here, and really think about covering the field. The same way that you've got all of the players on the field, all playing different roles, you need to think about how payment systems may meet certain business needs. So what does ACH and card and mobile do? You need to really think about how it fits into your business strategy. So importantly, you want to be able to stand out in a crowded market. You want to know, because importantly, I think for credit unions, and I think this is really part of your value proposition, you know your communities and you know your members probably better than anyone. So you can have a card scheme, you can have a switch, you can have a technology provider, whoever come to you and say, you know, I think you should do this and I think you should do that. At the end of the day, you know your members better than anyone. So by partnering and collaborating, you're able to then deliver the best service to your members. So how can you participate? And we've got a bit of a list here of things you can think about. Joining, as we mentioned, joining ACHs or debit card switches, becoming a bill payee of a local bank, entering a sponsored relationship with a card issuer to launch a prepaid card, entering a collaborative agreement between other credit unions in a single market to create your own ATM network. So, and having some kind of mutual recognition, or partnering with a fintech or a bank to roll out a mobile app. So there's lots of options out there available for you to think about in terms of how do you deliver to your members. As you do this, as you think about partnering and collaboration, you do also need to think about responsibility. Regardless of what you do, you're still going to be on the hook, right? So even when you partner or you collaborate, you're still going to be carrying some of that liability. So in terms of what is expected from central banks, from the operator of the switch, or by any other organization. So that means you need to take responsibility, even if someone else is doing some of the work for you, providing you some of the technology or capability, you're still going to be on the hook for KYC, AML, CTF, privacy, protection, and so forth. So figuring out ways in which you can deliver the service, accept your responsibility, and find the best arrangement is really what we're looking at. So some of the how is really around scale, control, and strength in numbers. Quite often credit unions are challenged in terms of time, expertise, and money. How do you get access to the best expertise? How do you get access to the best technology, given that you may have only limited resources available to you? As I mentioned briefly, there's sort of two ways you can really think about it. One is really around partnering. So partnering with payment service providers, technology companies, banks, established fintechs, to offer new payment experiences to your members. Sometimes that can come with speed and simplicity, but you may end up giving up on controlling cost. So there's a bit of a trade-off there sometimes. An alternative to partnering is collaborating with your peers, with other credit unions. So that could give you more flexibility in terms of how gives you weight and strength in numbers. It may give you a voice at the table and allows you to share costs, services, and compliance responsibilities. So collaboration through shared services is something which credit unions have done in many jurisdictions. I know some of you already participate in some of these, but having worked in both Canada and Australia, I've seen in Australia Cuscal and Central One in Canada, and both of them have been very, very important organizations that have delivered significant value to their member credit union organizations and have really helped the credit union sector flourish in those jurisdictions. So how do you get support? And I'm sort of in the wrap up here now. Again, finding the money, finding resources to do some of this work is good. There is stuff available. So central banks, development organizations, regulators, industry associations, standard setters, are making information available. So they're looking at finding that sweet spot between competition and regulation. So looking to central banks, looking to payment associations or to your domestic switches to help you work through some of these issues. There are also other global industry associations that have done some heavy liftings. Organizations such as the ITU or GSMA have done quite a bit of work in terms of providing assessment toolkits and so forth, materials that are publicly available. And lastly, where do you find assistance? So development institutions quite often have taken a keen interest in this. As I mentioned, so I've done some work through the Bill and Melinda Gates Foundation. They've taken a real interest in digital financial services. World Bank, IFC, all of these organizations have taken more and more of an interest in financial inclusion, digital financial services, financial literacy. So they are providing more and more support in this. So in terms of some of our experiences, in terms of wanting to approach these kinds of organizations for funding, it's really important that you understand the mandate and the goals of the organization you're approaching. What are they trying to achieve and what are they trying to accomplish? Make a good case for support. As I mentioned, I worked on a Gates funded project a while ago. They really wanted a strong business case. They weren't just prepared to hand over a bucket of money. They really wanted to know exactly what we were doing in the project that I was involved with. So you really need to have a clear strategy and a clear roadmap, and be prepared to accept some guidance. So these organizations, have some very good experiences, and sometimes if they are providing, funding, they can also provide a bit of expertise as well too. So there can be a sweet spot there, and they can bring those wider learnings as well. That's basically it from me. I think I'm more or less on time, and I think I will stop sharing now. So thank you very much for that. I think I clicked off my panelist slide, but I really appreciate it, and I'll stop sharing now. Thank you very much.
Great, thank you very much, Brad. I'd just like to take this opportunity to introduce the people who are going to be on the panel for the Q&A. Brad is joined now by Paul Macon, who is an internationally known specialist in digital financial services. He's got a particular interest in transitioning markets and the underserved. He was one of the principals behind the creation of the M-Pesa mobile money scheme in Kenya, and he's gone on to work with governments, development agencies, and financial institutions all around the world. You would be amazed where Paul has worked. Also on the panel are veteran Caribbean financial service experts, Earl Gill and Robert, known as Bobby Frederick, who have held high-level decision-making positions in many Caribbean nations. I'm guessing we're at about 14. They bring their regional expertise to the issue of how modern payments affect the operations and organizations of deposit-making institutions. So that whole idea of, you're going to go into these payments, how are you going to organize it? How is it going to affect you? And also what's involved in being in these payment systems from the point of view of the financial institution. So I'm going to let you guys take it away now. And first question. I have a question here, two questions actually, which are about the burden of rules and governance. So when an institution like a credit union is going to join something like, let's say, an ACH, and there are these rules, there are the governance, what are ways for them to manage that burden? And do you have some suggestions from experience? Who wants to take that one?
Look, I can have a quick, just picking up on something that I said in the presentation was that what I've seen in some jurisdictions, like I think in Australia, that's a good example, that credit unions in Australia quite often operate through Cascal, as I mentioned. There's actually 3 organizations that provide shared services in Australia, so Cascal, Inju, and ASL. That provide support for the credit union and building society sectors. They've worked very closely, and those sectors have worked very closely with government and regulators and central banks to take on some of the regulatory burden for some of their members. So in those instances, it's not necessarily the credit union who is governed by the rules. It is actually the shared service provider. So Cascal, for instance, or Indu or ASL in the Australian context. So they would be the participant, for instance, in the new payment platform, which is the new fast payment system, and they would be taking on some of that burden on behalf of their members. So again, I've seen that, but that does require a bit of work with regulators and central banks and with obviously the system operator to make sure that they're comfortable with that shared service provider sort of stepping into that role.
Earl, I know that you were directly involved with the bank that the international bank you were working with when the payment system, the ACH in Trinidad, was set up. Can you give a little bit of information about sort of what happened there and how much was involved?
Yes, thanks very much for the question. Just to pick up on what Brad is saying, some of what he said is very, very relevant. Obviously, you're embarking on a new initiative and you need to dedicate the appropriate resources to ensure that its execution is effective. So what we had done was develop a small project team who interfaced with the central bank, who was quite familiar with our clearing and payment processes, right? To focus on ensuring that all the parameters, all the mechanics, etc., were maintained. And then from time to time, obviously, we had to manage to see how things are doing, to get feedback, identify problems, so to resolve problems as we progress. So it does require some additional resources, but once you get it up and running, then that time and effort sort of drops significantly.
Okay, thanks very much on that. We also had a question about the expensiveness of cards, and are all card schemes equally expensive to a merchant? Are there some that are better than others? I know it's kind of a question that might vary from market to market, but what's out there for choices in cards?
Look, I can answer that really quick. I mean, I'll let someone else answer. Sorry, go ahead, guys.
Sure. Okay. Cards are expensive. It depends on essentially how much the card schemes and their member banks in country can get away with. And generally domestic card schemes are cheaper, but they have limitations in terms of it means that your card holders can't travel to other countries. So that's obviously a disadvantage. Can I just say we're getting really conventional here? There are other ways of doing these things, and that's my specialization. Cards are not the answer to everything. I'll let Brad get back in with the real world.
Look, I agree with you, Paul. I think that's an important thing to realize, that cards should be just a small, maybe not a small part, but a part of your strategy. If you see your payment strategy as just a card strategy, then I think you're missing the breadth of what's happening in the world. Cards can be expensive for merchants, particularly those international scheme cards, but as Paul said, domestic debit cards quite often can be significantly cheaper. So again, there's a lot of ways you can transact. There's a lot of ways. Technology allows you to break away from some of that. So, and I think as Paul mentioned, broaden your horizons and think a bit about, well, what else is out there?
Well, we have the whole rise of smartphones and fintechs and merchants who themselves are connected to a switch and can accept payments from you. There's a whole range of new technologies. The card transactions, conventionally they're what we call pull payments. You give somebody your account details and they pull the money out of your account. Whereas in many markets now, we're seeing increasing moves towards push payments, where I push the money from my account to the merchant's account. And that is in many ways a game changer. And the card schemes can see this coming. In multiple countries, they're engaging with push payments as well.
If I could just add, card schemes are expensive all around. When you consider on the merchant side of things, it's also an area that the merchants would want to move away from. And we were seeing more and more of that because discount rates are dictated, for instance, by volumes that particular merchant can turn. And all around, there is going to be a move towards further digitization as a suitable option on the merchant side as well.
Does anybody else out there have some questions? Yes, I see one about the issues of toolkits from industry associations and things like that as a way of institutions sort of getting a grip on what to do. especially a credit union. I mean, how do they start? What's out there to tell them about digital payments? And I think I'm going to hand that over to Paul because you've actually been the author of a number of these sort of toolkits.
Well, I've done a range of different toolkits, but one I was just looking at today, in fact, was a toolkit for a merchant to essentially plug into the back end as though it was the card scheme, and you use your, in that case it was a smartphone app to accept payments, and the back end would essentially simulate the payment system, and it could tell you whether you were integrated properly, and all sorts of other issues such as that. To be frank, the technical integration is really probably the straightforward bit. It's the understanding of the rules and the implications of some of the risks that you're taking on. And in fact, as a credit union, if I was a large bank and I was looking at a credit union joining my switch or my payment system, for example, I would be wanting to be sure that that credit union was understanding the risks as well, and was perhaps understanding, for example, the liquidity risk, the settlement risk, all of those things. And it's not trivial, but it's also not as scary as it sounds either. It can all be managed.
Okay.
Yeah, there will be regulatory considerations. I'm glad you touched on that, Paul, because there are going to be regulatory implications where those sorts of collaborations will evolve.
Yes, and if you're talking about payments generally and payments innovations, I'm surprised that when I've mentioned push payments, but nobody's mentioned QR codes yet.
Oh, okay.
Yeah. Which is the hot topic that's in many countries. I mean,
What do you have
it
to
sounds
say
like
about
innovation.
QR codes? And then I've got another good question. So go for it.
And also the other one I wanted to mention was the idea of using people's identities, digital identities. So instead of pay my bank account, it's pay me, pay my identity. And I link my identity to a specific bank account. And then I can change where the money goes as people pay me. I just change it on my phone. And that's been implemented in multiple countries already. And in fact, when it was implemented in Nigeria, my favorite story, the government lost, I think it was about 40,000 staff overnight because they discovered that they were all ghost employees. Cost saving overnight.
I have another question here. Given the various emerging technologies, what are the most common trends? The question is, given a greenfield site, which is the smartest way to go? I guess that's going to depend on the institution, but who would like to take that on?
What type of payments are we talking about? Retail payments or credit union to bank or credit union to credit union? What, or G2P, the whole state beneficiary question? It really depends on the type of payment you're talking about. So if it's a retail payment, QR codes is becoming really big, and QR codes combined with push payments as well. That's huge in China, it's huge in Singapore, and it's coming to a country near you tomorrow.
Okay. I think that's, let's see what, got another one. Yeah, okay, this is interesting. This is about saying that credit unions have the luxury of flexibility right now because they're not regulated the same way that banks are. Would joining a payment system and its concomitant rules affect that level of flexibility in terms of the kinds of lending they do, the kinds of products they offer, that sort of thing?
I guess it depends on the rules of that system. So, I think, again, the system may demand them to do certain things and to have certain practices in place. And, that's a bit of the trade-off, because the system is there to manage risk. It's there to manage risk for the participants and for the system as a whole. So, you need to take on some of the responsibility. As I said, there are ways in which you can manage that responsibility. It may be through a shared service. I mean, that's one way of doing it. It might be through partnering. It may be through getting access through an existing participant. So again, I don't think you can game it too much. I think you really need to confront it head on, and to be prepared to take on some of those responsibilities if you want to be a full participant in those systems.
Okay, that's yeah, I can see that. I'd like to send something towards Earl and Bobby about their experience in the Caribbean, and talking about things like setting up shared services, especially about compliance and so on. And then what does that do for your organization? What are the opportunities that it then does? How does it affect roles and responsibilities?
If I
Yeah,
could, go ahead, Earl.
yeah, I think that the whole shared services concept is a very, very interesting one. And I think the focal point has to do with the customer. And the question is, how do you serve your customer better? How do you increase share of wallet? And that means going after the competition, etc. So you have to look at creating economies of scale, creating efficiencies, creating best practices, creating centers of excellence. Like when you go to a shared services concept, it means now you're building people with knowledge who are looking at the way they process loans every single day, so they get to understand that better. In terms of credit risk, they tend to understand that better because they're dealing with loans every single day. So these are the benefits that you're going to get. And when you move to a shared services concept, it means now that your costs are going to be reduced. So your transaction costs will come down. I think that typically the credit unions transaction, the ticket sizes are probably a bit smaller than the banks. So your processing costs on a per item basis might be a lot higher. So if you can bring that down, it means that you can then improve your profitability. You can then establish better financial.
We've got a technical glitch here with Earl.
Okay. If I could perhaps continue
Yeah,
where
go ahead, please.
left off. There are other benefits to be gained from shared services, as well as the ones that raised earlier. You tend to be in a better position, and this will be subject to cross-institutional collaboration to develop centers of excellence, for instance, in back-end processing, which would be essentially invisible to your membership, and puts the institution in a better position to concentrate on sales and service activities and meeting the demands of their membership. But I think the success of a shared services arrangement will be highly subject to what level of relationship across institutions in the particular jurisdiction that currently exists.
Hello, Lisa, can you hear me?
Yeah.
Am I back?
I can hear you now.
Yes, okay, yeah, thanks Bobby for picking up on that. I think that is very good. But one of the other things that I also want to mention is that with the shared services concept, you're then in a better position to gather information on your customer. So you start to build better customer information files, which then allow you to cross-sell, upsell, and to ring fence your existing customer. So for argument's sake, you have an existing customer. If you're in a position to, via improved technology, as Brad articulated, right, to provide that customer with the products and services that they need, then the possibility of them going to a competitor is reduced. And this is key again in increasing that share of wallet. So, and it also allows you to target, to segment your customers. You can look at this information and segment your customers and target them appropriately for the various products and services that you really want to go after.
I've got a couple of questions here, absolutely for Paul. I've got wanting a little more details about things like QR codes and push payments. But before that, there was a question that was really relevant about that a lot of customers actually find that they don't have smartphones, data is expensive. What are some of the options that are data light that don't need a smartphone?
The card is the obvious option, and also the possibility of modifying ID-based payments, the Pay Me option, so you can use an ID card to source or direct a payment.
By ID card, do you mean sort of like a government issued ID?
Yeah.
Okay.
Authenticated, preferably biometrically authenticated, so that I know that it's the right person using it, for example. You shouldn't underestimate the power of a card, but a lot of the cost of a card is actually just that little logo in the corner that has the scheme name on it. That doubles the cost of a card at least. If you can do a private scheme or a national scheme, the card becomes much cheaper. I ran a scheme in Nigeria where we were issuing cards at a tiny fraction of the cost of the cards that were being issued in Europe, and the reason for that was that we were using the same plastic, but we were printing it ourselves, and it didn't have the certified logo in the corner. It was exactly the same card.
I know you've done work with feature phones,
Yeah,
and the
yeah,
idea of, what can you do without it
I
needing to be a smartphone and big data?
I really try to avoid this subject.
Oh no.
M-Pesa, when we launched that, we used feature phones, entirely feature phones. And the reason we could get away with that was because we had access to the SIM. And we used that as a secure vault for encryption and the identity of the phone holder. If you don't have access to the SIM, then a feature phone is inherently very insecure. SMS is easily spoofed. You can, for M-Pesa, we actually put authentication on SMS so that you knew exactly who the SMS was coming from, and that was bidirectional. But that was because we could get in the SIM.
So in this market, not necessarily the way to go.
Yeah, and the other option, of course, is USSD, which I think is an acronym for totally insecure but cheap. You see it being used everywhere, but it's when you start off a transaction with *40# and then a set of key presses after that.
Okay.
It's ubiquitous and it's totally insecure. And please don't start developing systems using USSD now if you can avoid it.
Okay, we're getting near the end of our time, but my partner in crime over here, Peter Castanos, who has spent some significant time in the Caribbean working with Bank of Nova Scotia, has a question also for Paul, based on the fact that that agriculture is one of the, everybody thinks about tourism with the Caribbean, but agriculture is a big thing here too, and what are some of the ways that, let's say, a credit union getting involved in digital payments is going to be able to help people in agricultural value chains, or people who are, geographically a far way away from being able to come into the city and the branch?
It always surprises me that banks, so far as I can tell, spend very little time trying to actually understand their customers and their needs. And there's nowhere that's more apparent than in the agri sector. So you issue a loan to a farmer for planting his crop, whatever it may be, and then next month you start demanding repayments. And the farmer, certainly the small farmers, they have no money from the moment they've planted their crops till the day they harvest them. There is no money, and so demanding any repayment before that is just meaning that they will not take a loan from you, which is to your detriment because you then losing that income. So thinking about that, thinking about the cycle of the farmer, and for that you have to understand their crops. So there are crops which it may be 9 months from planting to getting the crop. Or the most extreme example I came across was actually sugarcane, where the example I found was that it was 18 months from planting it to actually getting a first harvest off it.
So I'm cutting in on you here, Paul, but how does sort of the idea of, let's say, a credit union getting involved in digital payments, how does that help them to support a farmer in these sort of circumstances?
To understand the needs of the farmer, and you have to understand them in the round. It's not just about their crop. The fact is that a farmer, certainly a smallholder farmer, has a family, and his children want to go to school, and they all need to eat, and they need to pay insurance, for example, for their crop, whatever it may be. And if you can truly understand the farmer, then you can design products which are of use, and that can substantially increase the size of your business. I've worked in a number of agri initiatives in this space, digitizing the value chain, it tends to be called. And generally they fail because you don't take into account the farmer's life in the round. And there are things that can be done. I mean, if we just stick to the actual produce itself, there's a big export market for agri produce, clearly. And if we started considering perhaps the exporters starting to make payments in advance of some sort, escrowed in a credit union, for example, so it's only paid out when the produce is delivered. That could then be distributed up the value chain, subdivided, so it goes from the exporter to the wholesaler to the agents and also up to the farmer. Continual subdivision of that escrow right up the value chain, and that not only means that the farmer is guaranteed his money when he actually delivers the goods, but also it means that that farmer can start to leverage that escrowed payment for intermediate small loans against the escrowed payment. And that can just help to smooth that bit between the sowing of the seed and the cutting of the crop, for
Right.
example.
If it's all digital, you can keep track of it all the way.
Exactly.
Lose anything, everyone knows where
Yeah.
they stand at all times.
And you can sit in your back office somewhere and release the payment with a push of a button.
Okay. We have used our hour. Gentlemen, thank you very much. Denise and of course the CCCU, thank you, and thank you to everyone who attended. This has been a really wonderful opportunity to speak with you.
Thank you, everyone.
Thank you.
Thank you.
Thank you very much, everyone. Have a good day.
Thank you.